even after all of this, and we see that, oh, wait a sec, so Silicon Valley Bank falls apart, Signature Bank is shut down on a Sunday, Silvergate Bank shuts down, and then we see that the banking stock market falls apart, and then we see the feds jump in, we see Biden make an announcement saying that everyone's going to become whole, and not only 2 weeks later or a week later do we see the demise of Credit Suisse fall apart in the Swiss markets. And so now the European markets are on the fringe of some sort of catastrophe, and now we have to look at that. So what do we see? We see the largest institution of Credit Suisse fails and enters now the third largest asset management company of today, because they took on Credit Suisse, and now they got a seat at the table with BlackRock and with Vanguard, and then the third largest happens to be now UBS. And so mind you that the price to have a seat at the table was north of $3 billion, and yet what's staggering about that is it cost $3 billion to take on Credit Suisse, and from 2000 to now, Credit Suisse was fined up to $11 billion, almost 3 times the amount or 4 times the amount in fines. It is compared to the price that it took to buy them out. And then they have $100 billion line of credit. And I have to say, if that's not enough, we have more to say about this. So what else is unprecedented? What else is unprecedented was in that acquisition, we found out that there was these AT1 convertible bonds that the way that a waterfall works is that you have your depositors, and just to kind of give you just a quick layout of how this would work, it would be your depositors, and then it would be your bondholders, and then you would have your equity stakeholders, which is shareholders buying into the stock, etc. In this particular case, the bondholders, they got wiped out. So the equity stakeholders had precedence over the bondholders, which is already blowing your mind, because what we have to understand out of that transaction is, how did this happen? Well, it was written all over the bond pool and within the contractual agreement, but I don't think that we could understand that this is an absorption loss, not a liquidity issue. And so in order to trigger this clause, we have to first understand, is it a liquidity crisis or is it absorption? And I'm willing to bet that depending on which side of the fence you're on, you're going to be able to argue your claim here. And so if that's the case, then the bondholders shouldn't have been put in this position where they net zero, because the write-down says, hey, it becomes a convertible asset. That convertible asset now turns this into liquid cash, basically, and that's how you fuel the banks, by giving them their liquidity back. And so the one that's responsible for that would be the bondholders. And so you're rewarding these stake equity holders, and you're not going to reward the bondholders. What does that say for the value of bondholders? And so all these things are unprecedented.